Hey Fools, welcome to this week's edition of Digging for Value. We're looking at a lot of earnings. We want to first off kick off with the coal industry, industry that has been hit pretty tough over the last year. What are you seeing here?
We saw earlier this week coal companies shot through the roof in the market, leading the market actually with some returns. Peabody was the reason why. You look at this company talking about increased demand in the United States, which really caught me off guard. And one of the reasons why is because natural gas power generation is down 15% in this first half. So you saw 11% rise in coal demand here in the United States. And you're not seeing their revenue is high, but that's not necessarily a bad thing because the users of this coal are reducing their own internal stockpiles. So inventories are down about 25% year over year. So they're going to have to repurchase a lot of coal. So it could be a strong second half of the year, maybe even a strong beginning to 2014 for them. Internationally, you're seeing China finally starting to realize that supply is way too oversupplied. So they're finally cutting back on production, much like companies in the United States have been doing for the better part of the last year. So that's finally starting to help inside the market. But then you notice more demand internationally as well. India, coal-fired generation up 9%. You look at Japan, without nuclear fuel over there, they're up 5% this first half. And then India followed right in the footsteps of China, up 9% as well. Or excuse me, Germany followed in the footsteps of India, 9%. So really seeing it from all angles, Europe and Asia, which I think is a great thing for the coal industry.
Yeah, definitely. I think it was a huge surprise seeing Japan there because a lot of people, they've been importing so much natural gas. Nobody really thought that coal market might pick back up, but being the prices where they're at, they saw that drive. So that's very interesting. Also in the material space, we saw some diversified and copper companies come out. Freeport-McMoRan, how do they do?
Yeah, they did all right. You look at their earnings, and without that acquisition, or there's two acquisitions that they finally closed after some consternation there. They closed it in the middle of the quarter. It accounted for 55% of their earnings. So without that, they would have been in a very dire straits here. Much like their competitor, Southern Copper Corp, didn't perform as well as some might have hoped. Unfortunately, copper just hasn't recovered on a price-wise basis. So you look at this company, kind of performing a little bit different than its peers with a long-term view. They're actually spending a lot more money with capital expenditures, trying to grow production, where a lot of their peers are just maintaining the production that they currently have. You look at over a 70% increase in capital expenditures in the first half of this year over 2012. So if copper picks up, you're really going to need to see demand, I think, before the pricing picks up. But if that happens, they might be in the best position of all the copper producers around the globe. But if it doesn't, as Caterpillar expects with their lowered guidance for the remainder of 2013, which absolutely crushed their stock in the mining sector over the last couple of days, Southern Copper could really be in a pinch. And then turning from that to the oil sector, we've experienced tremendous growth, and one of the reasons why is energy services companies are boosting their technology, and you've seen some great earnings out of one that you've watched for a while.
Yeah, definitely. I've liked Core Labs for a long time. And really this quarter, for the third consecutive quarter, they've had record revenue, net income, and earnings per share. This is a nice company because they can really scale out. They're not too capital intensive, so they are more of a service company. As more jobs come online, they can go out and hire the scientists that they need to really expand. So I really like that part about their business. And if you look at what they did this last quarter, they really focus on three financial tenets. And the first one is maximizing free cash flow. They've been doing a great job for a number of years. And this quarter especially, they returned for every dollar of revenue, 23 cents in free cash flow, which is extremely phenomenal. They have very strict financial discipline, basically high hurdle rates. And if the project doesn't come close to that, they're going to reject it out of hand. So very nice for shareholders because you can count on them to continue returning capital to shareholders, and that's another one of their big tenets. And this quarter, if you look at what they've done, they've returned through either dividend or share buybacks about $1.45 per share. Earnings per share this quarter was $1.32, so obviously they're returning more to their shareholders than what they actually brought in, which is very nice. And the other one is their return on employed capital. And really, when you look at this, they do a phenomenal job. No other service company really even competes in this metric. So obviously, they're doing very, very solid work all around.
Yeah, and so now when you look at what they've been able to do, you kind of have to scratch your head, and a lot of the services companies haven't been able to do that. So what really sets this business model apart?
Yeah, definitely. They have three different businesses, and the first one is the reservoir description. This is an area that's been very solid. They saw record revenue this last quarter here. Really, the margins were second best, only outdone by the same quarter a year ago. And if you look at them in this space, I really like the potential that they have, and they're really getting into the enhanced oil recovery with a lot of aging fields and a lot of potential in the Gulf of Mexico for EOR. Being the kind of the leaders and pioneer on a number of of ways to tap this, I think is huge for them over the long term. Then also they have their production enhancement, and this is an area that's even grown this year, although the rig count in the United States has dropped by 10%. So there's obviously, if that picks up, that their business can increase by that much more. And then they also has their reservoir management, and that's up 13% year over year. Very solid. They're jumping into a number of plays in the United States, a lot of the solid shale plays, Eagle Ford for one, and they're also jumping into a lot of projects in West Africa, so very solid. You know, what I really like what they're doing, this company's doing. As oil keeps increasing in price and as cheap oil and more unconventional drilling is becoming more of the norm, people really want to increase as much yield as they can,
yeah, of course.
And this company is one of the best to do that. The only problem I see with this company is some of their best customers, big oil like Exxon and Chevron, are also doing a lot of this in-house. However, they're still outsourcing this, so if they decided to bring that in, they would have to rely on a lot of the national oil companies. So that's one of the worries here. But going back to the material side, we saw a number of steel companies release earnings. So why don't you start us off from there?
Yeah, this is a highly competitive industry, very fragmented. A few large North American producers, but globally, very tough market with China really dominating on the production side. So you've seen some struggles here over the last few years. In 2012 and early in 2013, really killed the margin expansion that we had seen coming out of the recession in 2010 and 2011. You see prices down 8% over year according to Steel Dynamics, but only 1% quarter over quarter. So there might be a trough forming, and AK Steel kind of leaned in that same direction as well. So we'll kind of have to pay attention to the third quarter and see if the profit or the price continues to slow down on its decline or maybe even uptick. You look at Nucor, seems to think that it might. Their sheet steel price was very low in June, at lowest since November of 2010, but they have seen some rebound there. So this is their largest segment, accounts for just over 50% of segment-wide revenue. So if they're right about this rebound, they could be in a great position moving forward.
Yeah, definitely. When you talk about this rebound, what are you really looking for? How do companies or investors really notice if they're at a bottom? So why don't you get a little bit more into that?
Well, noticing the prices is definitely something that you have to pay attention to. So if maybe you have a quarter or two of flatlining, maybe you see prices picking up, but you gotta also have to pay attention to end users. The automobile industry is huge for steel. Even though aluminum has crept in a little bit, it's still one of the largest purchasers of steel here in the United States. Also, the oil industry is picking up the pace. If pipelines get approved, who knows how much that could help steel, because that is the predominant resource built into these pipelines. So that's a couple of areas that I'm looking at. Also, non-residential construction just really has to pick up the pace. It typically lags residential construction by a couple quarters, which you've seen do very well over the past few quarters. So maybe non-res will pick up. I know there's a lot of towers here in DC and Arlington going up, so if that's the same way around the rest of the country or about to be, that could really pick up for them. And then if it doesn't, I look for Nucor. They've got that DRI, direct reduced iron facility, coming online. It's going to be the only one here in the United States. It should be in line in the end of the third quarter. So that's going to really help their cost competitive advantage because they've kind of seen that erode over the last few years, which they originally, with their mini mills, just dominated on cost. So now this could realign them with that. So that's what I'm looking for. And the oil boom could really help, but something tells you that might not last very long.
Yeah, definitely. I mean, if you look at the amount of growth that we've had, the EIA is basically estimating that the United States could be oil independent in the next 20 years or so. But if you look at the amount of growth, it has been so exponential for a number of years, and to keep increasing that growth obviously is going to mean that they're either more development or longer type curves, but that's really not the case, because if you look at a lot of the growth, it's all in shale plays. And if you look at the Bakken itself and look at some of the numbers over the last few years, you saw in 2012 they had 20% growth. It came in about 281,000 barrels per day of growth. So if you look at that to increase this year, what they'll have to do, they would have to bring that up to another 20%, which really at this pace that they're at right now, they're not even coming close to. Through May so far, they've increased production by 70,000, about 71,000 barrels per day. So to get to that level, they still have a lot of ways to go. But at this rate right now, you can see that they're still increasing, but they're increasing at a decreasing rate. And what's important here is when they finally hit that plateau. And there was some good insight from Core Labs earnings this last quarter. And David Dimshore, he's the president, CEO, and chairman of the company. He basically sees this plateau in the next 6 quarters, and he looks at the Bakken too and says, you know, to increase the amount of oil that they're producing right now, they need to add about 4,000 producing wells in 2013. However, the most they've ever added in the Bakken was 1,700.
Yep.
So obviously well short. So far through May, they've only added 564, so they're not even close to that 4,000. So if what's happening in the Bakken carries through to the Eagle Ford, which is the other big play, and some of the other smaller shale plays, really oil growth is going to plateau. Obviously, it's going to be a lot better than we were 5 years ago, but the growth portion is going to plateau. And then with the steep curves that they have, where you're losing about 80% of your production within 2 days, if they don't increase the yields, then that could be a worry. And EOG chairman Mark Papa, who's been in the industry for a number of years, basically has come out a number of times and told his company that the growth is going to start decreasing. So he sees this and sees a lot of the projections by the EIA as off, because it really can't sustain at that level.
Yeah.
So, what would really help them out, though, or a number of companies that I think that could benefit here, are service companies. And if you look at service companies and increasing what they're doing in the shale plays, we probably got some pretty good insight from them who had our earnings this last week or so. So why don't you get a little bit into that?
Yeah, well, you look at a lot of the major service companies in 2012 and the first quarter of 2013, really hoping that the U.S. market could pick up, and you've slowly started to see that happen just a little bit. Halliburton showed a 3% uptick in revenue and a slight gain in margins, which was very nice for them. They're one of the leaders here in the domestic market when you're looking at people specializing in fracking. So if like you say, growth starts to taper off, you could see a drilling frenzy go on just to maintain current production, because the demand certainly isn't going to go anywhere. So I'm looking at these companies domestically to really start to pick up, hopefully, even though the rig count isn't. They're drilling more wells per pad, and they're also drilling longer horizontal wells, which is definitely labor intensive, and this is where these companies specialize. So while it hasn't happened yet, this is a long-term play over the next 3 to 5 years, where I think domestically these companies are really going to thrive.
Yeah, these companies have been pretty happy with staying flat in North America, and with the rigs down by 10%. By being able to stay flat is a big win for them. However, they've been driving a lot of their revenues, and they have had good, pretty solid outcomes coming in the international phase. So why don't you get more into the international side of their business? Yeah,
this is an international business that's largely dominated by Schlumberger. They've been all around the country. They haven't relied on domestic market as much as their competitors like Halliburton. You look at over 60% coming internationally, which has been great for them over the last year and a half. And so Halliburton, though, is slowly starting to chip away. They're having larger year-over-year gains, quarter-over-quarter gains than their peers. So it kind of hints at them stealing a little bit of market share, but they still have a long way to go to catch up to Schlumberger. You look at Halliburton's growth, they focus on the Middle East and Asia, looking at Iraq and China really starting to move into more fracking, at least R&D, maybe not full-bore fracking, but they're definitely starting to be teased with a little bit. So I look at Schlumberger and Halliburton, who both have R&D facilities in China to really focus on that. And you've seen revenue and margins expand almost at double-digit percentages year over year and quarter over quarter. So they expect this growth to continue, and that's what really has been kind of buoying these companies as the North American market has struggled. And one area that I've really looked at is deep water in the international space, and I think that there's going to be an ongoing battle between FMC Technologies and Schlumberger here. They've both been receiving company record level deals with Petrobras down in Brazil, and that activity is only expected to grow for the next 5 to 10 years exponentially, because they really haven't even begun to tap that pre-salt formation that could be the largest deep water formation around the globe. So I look at both of these companies doing very well there. As far as a winner between the two, it's tough to say because FMC's been there for so long. But now that Schlumberger's teamed up with Cameron, with that deal finally closed in June for their one subsea venture, I think that that's going to carry a lot of clout moving forward, and it could pose some major problems if that really does catch on. So I'm going to continue to watch that. But turning to natural gas in the United States, that's one area that Halliburton and Schlumberger and Baker Hughes are really going to rely on, and you've kind of got some insight into that based on current prices.
Yeah, definitely. It's been an industry that's been beat up. When you saw record low prices early last spring, basically the price per 1,000 BTU or million BTU dropped below $2. It's up about 60% from them. However, a lot of natural gas producers still really can't make a lot of money here. The low-cost producers, however, can. And now that they're finally getting to that phase where they're past the held by it production, where they're not going out and drilling just to keep their land, they can really focus on efficiencies and lowering costs, and you're really starting to see that. And we had 3 companies this week release earnings, and the first one was EQT Corp. Really what they've done is they've really targeted the Marcellus. Their Marcellus production is up 111% this quarter, year over year, and production for the company overall is up 54%. So they're going out and really jumping in there, drilling more, and they're able to do this because they're selling general and administration costs are down 32%, and their lease operating expenses are also down 20%, which is very solid. You're also seeing very similar things with Range Resources, production up about 27%. Their unit costs are down close to 10%. Another company that's up their guidance, just like EQT. And then a big surprise out of the big Cabot Oil and Gas, they also increased their production by 52%, which is huge. Yep. It's 7% sequentially quarter over quarter, so that's a big number for them. And they've also gone out, really lowered costs. Their total unit costs this last quarter coming in at $3.10, which is very nice, especially with prices in the $3.50, 60 cent range. And then if you tie in their hedgings and they actually had a realized price of $4.06, they can actually go out and make pretty good profit. So what I really like about these companies are they are the low-cost producers. They keep getting better, lowering costs and dragging out, increasing the yields that they're getting from their wells, so they're looking very solid.
Yeah, certainly, and I'm certainly glad as well that you've been able to point out a few industries that are doing well. While I got saddled with the ones that weren't doing very well, I'm just unfortunate that I've been focusing on them a little bit lately. So I think that there's investment opportunities involved in both, and we're going to continue to dig for this value. So I hope you tune back in next week, or we'll present some more ideas that you can focus on as energy and materials investors. Keep fooling on.